Welcome back to the Professional Ag Marketing Riskology series. This YouTube series is geared towards farmers wanting to learn more about managing price risk on your farm involving futures and options. The 12-part series should give you everything you need about price risk management journey. Trading commodity futures and options involves substantial risk of loss and is not suitable for all. Again, these are just examples. If you have any interest in placing trades, please contact your risk manager for a strategy that suits you. So far, we have talked about risk management. We've talked about intro to crop insurance. We've talked about cash versus futures. And today we're going to get into the intro to options, the fourth part of our series here on our Riskology series. So as you can see, this is our outline for today's video. We're going to talk about the intro to the series here a little bit. We're going to talk about who uses them, what are the options that we talk about today, when to use those options, and then just a few examples to round off of strategies that would be normal for farmers, investors to be using option strategies involving things like commodities. So we'll be talking a lot about corn specifically today, just as an example, but these options are something that can be used for a wide array of many different commodities. So let's get into it. Let's get started. Let's talk about who uses them first. The first one that this is going to be really geared towards is a hedger. This is who we're targeting in this video, for example, to use options. This would be someone with price risk in a physical commodity that they're trying to protect. For example, a farmer who grows corn. If price goes down, we want to protect in case that happens. Or a hog producer who buys corn, for example, for feed needs. These would apply to him as well. A speculator would be the second type of person, and this is just someone looking to make a bet or as an investment, for example, using option strategies. For example, if a speculator thinks that a price of corn may go up for any reason, they could build an option strategy to take advantage of this. Some of the factors that could influence option use would be things like seasonals, fundamental long-term objectives, fundamental trading, or technical trading, or just even a speculator, for example, who wants to hedge some of their bets. If they have futures on, for example, they can use options to protect themselves. So a few things worth mentioning there. When I look at what are options specifically here, we'll get into a very definite answer, which is option contracts are contracts giving the right to buy or sell futures at a set price before expiration, and they are a risk management tool. Options help farmers manage price risk from weather demand or supply changes without committing physically. Put and call options, those are the two types of options that we're focusing on today. Those are the two options you'll be talking about most of the time here. So put options secure minimum prices, while call options allow for profitability from a rising market without physical storage. So a call, the example I would like to say to describe the two would be like a phone call. If I'm going to pick up the phone or call somebody up, that'd be calling someone up, so the market goes up. If I wanted to think about a put, I put the phone down. So those are the two option scenarios. If I'm going to buy an option, I'm picking a call up and I'm putting the phone down, for example, to help distinguish which one is which from a buyer's perspective. And then scalability and market dynamics. Each option contract covers 5,000 bushels with the value affected by futures prices, volatility, and time. So there is a little bit of a factor that's not just one-to-one here that we'll get into. But when it comes to quantity and size, this is important because you can do things like mini contracts on grain, for example, where options, you're only limited to a 5,000 bushel contract. You don't have that option to do 1,000 bushels, and this makes it tough, on soybeans, for example. A lot of folks produce 10 or 15,000 bushels of soybeans, where if you did 2 or 3 option contracts now, that covers a huge portion of your crop. So that's something worth mentioning on the option strategies, where something like corn, for example, the bushels take a little bit longer to add up. If I'm going on to our next point, let's just talk about one of our two options here. This is called a put option here. When I look at put options, they let farmers lock in a minimum futures price. They protect against market price drops effectively. So this is the put down scenario. If I buy a put limit losses to the premium paid, offering safer protection than just selling futures outright. Put options support both pre-harvest and post-harvest decisions. They enhance marketing flexibility for farmers, and it's an insurance-like protection, really. Puts act like an insurance by protecting price rather than something like a yield or providing security in volatile markets. So when I look at a put option, mainly I would think about, if I'm buying a put option, I'm trying to protect the price from going down. So if I'm a row crop producer, if I need a strategy using options that would protect price from going down, which is very common, right? Where we grow something, we don't really worry if it goes up too much. It's just if the price goes down, I'd be buying a put option in that example. So same for hogs. If you grow hogs, you'd be worried about the price that you're selling that hog from going down. You would buy a put option to help protect that price from going down. Cattle, same thing. If you grow cattle, you're worried about that price of the calf going down, so you'd be buying a put to take advantage of that. The next one would be a call option. Call options give farmers the right to buy futures at a set price, ideal when expecting price rises, but not the obligation. After using, farmers use call options to re-enter the market on paper after physically selling grain, for example, capturing potential gains. That'd be like a one way of doing it as a re-ownership opportunity. Call options, they do offer a way with limited downside risk just to the premium paid, and they offer safer exposure than holding futures contract outright. So for a call option example, it provides a lot of flexibility during very unpredictable weather, market swings, things like that. So if I look at a call option, a hog producer may be worried about their input costs. For example, they feed corn to their hog. They want to protect price from going up and on that corn, so they may buy a call option to protect that feed input price. And same on a row crop producer's perspective too. Let's say that we've made a lot of sales at okay revenue levels, whether it be cash or HTA levels in the past, and I have a lot of corn sold at X price. And if the price of corn starts to go down, for example, you could buy call options to protect if the price would go back up, just to give you a little bit more cushion, a little bit more comfortability in your sales that you've put on. And or even if the price is going against you, let's say I sold corn at $4 and the price is at $4.50 and you're worried about it going to $7, you may be able to buy call options on corn to protect yourself in case price does really go up, to give you some more upside if needed. And this is nice rather than just getting out of the futures or buying futures back, because this is only a small amount of premium paid. Rather, that's the most money you can lose, rather than risking all or nothing using futures, for example. So that's just something worth mentioning. So there's a couple different ways to look at puts and calls both. And this is where it starts to get really confusing, because so far I've only talked about buying, the buying side, but you can buy or sell options. You can buy or sell a put. You can buy or sell a call. And when I look at buying options, this is maybe a little bit simpler side of things, is defined risk with premium. Farmers pay a premium upfront. They limit maximum risk to the amount paid, similar to an insurance fee, for example. The upside potential and protection. Buying calls offer unlimited upside potential without margin calls. Buying puts protects against falling prices. It could fall to an infinitely lower price, and the only amount of money you'll lose is the premium paid, for example. Option value decreases over time due to theta. Higher volatility increases premiums due to unpredictable markets. So one of the ways we look at this is, if the market is at $4 today and I buy buy a $4 put to protect myself on the downside, for example. Let's go a couple months down the road and we're only 2 days from when that option expires. If I bought a put to protect the downside from $4, but I'm trading at $8 now on corn, the likelihood of that $4 put being in the money or paying off is very unlikely. So that put isn't going to be worth anything. It'll be worth effectively zero. Now, if I bought a put at $4 today, and let's say I spent 15 cents and it expires in a couple months, and then we get 2 days away from expiration and we're still at $4, that put I maybe spent 15 cents on before, it may only be worth like 4 cents today because it really doesn't give us much protection no matter where price goes. The time ran out for the ability for the market to run too hard, too fast. One of the ways to really see this as well on just theta is if you look at option values ahead of a report, like the WASDE report, for example. There's a lot of volatility, a lot of things that can happen around a WASDE report. It'll lose a lot of time value through that WASDE report. So if you bought an option the day before and sold it the day after and you're at the same price, it may be worth a lot less the day after just because that time value escaped it a little bit. So I think that's something worth mentioning with options is it's not one-to-one, so to say, with where futures, if I bought futures and the price of corn went up 10 cents, your option went up 10 cents. So this is where it starts to get a little bit confusing. And to build on that a little bit here, let's talk about selling options because this can be a really confusing part as well. We're going to talk about obligations and risks first. So selling options requires taking on obligations that can lead to substantial losses during price fluctuations. And with that being said, buying an option, you only risk what premium you pay, whether you buy a put or a call. The most you're going to lose is that premium that you paid. When you sell an option, your max profit is going to be what you collect on it, that premium. The maximum amount you could lose is unlimited. So, for example, this is a marginable position. Option sellers must maintain margin accounts. They face potential margin calls and increased financial stress if that position does start to go against them. One of the ways to look at this is if I am trading at $4 today on corn and we sold a $5 call and I collected 10 cents for that call. And let's say 2 months down the road, we had a weather problem or something and the price of corn went to $6. So I sold that $5 call for 10 cents, and now it's at $6. I would have had to kick in at the end of it, if we expired, 90 cents on that call. And it actually starts to occur, that margin process, even before you get to $5. Because let's say if I sold it for 10 cents today, that $5 call, and we're at $4, what if we went to $4.50 tomorrow? We went up 50 cents on that call. And that option value, that call we sold, is a lot more likely now that that's going to be in the money. So that call has to go up in value along with it. And it may not go up full 1-to-1 like we went up 50 cents. So that call might not go up 50 cents in value, but normally it would go up like half that amount. So maybe it'd go up 25 cents now. So the call you sold at 10 cents is now worth, 35 cents, for example. And that 25 cents that increased in value, you're going to have to kick that margin in right alongside of it. So that's something worth knowing, and it has initial margin tied to that as well. Experienced marketers, they use option selling to generate income or improve marketing, requiring very disciplined and known expertise. This can be very risky, but a lot of the time, if you look at a market, you could tell yourself, today we're at $4. What's the likelihood of $6 actually occurring on corn next year, let's say? It's not very likely. $2 rally on corn, not very likely. If I look out there, someone's willing to buy that option at an X amount of price. And you could say, just weigh out the risk, and you could say, oh, I could sell that, and I could just put that 5 or 10 cents, et cetera, in my pocket and say that's probably not going to happen. So you really have to weigh the risk to reward here when selling options. It also may just tailor to, especially in a hedging perspective, let's say I want to protect price today, but it's maybe not quite at the profitability level I want it to be at. I could look at that and say, well, I could buy a put. And I look at the put options and it's like, well, I don't want to get too far down in price because then I'm not protecting much or even a profit. But I want to protect a put near the money. But it's so expensive that it'll eat away most of what I'm protecting. What can I do? Well, you could go up and you could sell a call, for example, above it to help pay for some of that put premium. And this is one of those collar window fence strategies that gets used a lot when you have a physical commodity backing it up. Because if I'm growing corn, I can sell a call and not worry about price going up because I can sell that physical corn and make up that profit. Sellers must fully understand risks, obligations, and market conditions before they encounter any option selling for sure. So what makes up options? So you have two things. You have intrinsic value and you have time value. So intrinsic value is going to be, for example, if December corn futures are trading at 5.20 and you own a $5 call, which is the right to own corn at $5, not the obligation. The option has 20 cents of intrinsic value because it's already in the money. So if I was going to tell you, do you want that call or not? If I just gave it to you for free, you would say, oh yeah, I want to be long at $5. We're at 5.20. I'm making 20 cents on the deal for free. No intrinsic value, it would be like out of the money, for example. So if corn's at 4.80 and you own a $5 call and I wanted to give that to you, you'd say, well, probably not. It's worth $0 today, so it's not worth anything. The time value, uncertainty plus opportunity basically is what the time value means. And this is where it starts to get really tricky with valuing options. Any price paid above the intrinsic value is time value. This reflects the chance corn improves or moves past that price due to weather, USDA reports, exports, demand before expiration. So, for example, a $5 call today, and we're trading at 4.60 on December corn, for example. That corn call has zero intrinsic value because it's way above the money. It's out of the money. But it's worth something. Let's say it's worth 10 cents. Well, all of that value then is going to be time value. So that's worth noting. If you can look at this another way as well. If we're trading today at 4.70 and I own a 4.60 call, for example, the intrinsic value then is 10 cents, but that call may be worth 20. So then that would show that there's another 10 cents of time value attributed with this. Now that time value is always going to fluctuate based on time and volatility, things going on in the marketplace. So when you have things like black swans happen, for example, and the price of corn is moving all over, that time value and the value of those options gets really expensive. The intrinsic value won't ever change. Intrinsic value is always 1-to-1. It always makes sense. It never changes that formula. And one last thing on that is, well, corn options are worth only intrinsic value. All-time value disappears at expiration, which is why option value decays as expiration gets closer. So the day of expiration, there won't be any time value left once it expires. So let's talk about when to use these options a little bit. But first, I just want to talk about when you decide on an option, always keep this picture in mind. This can be very helpful with identifying your goal. With the strategy, are you trying to protect the downside or protect the up move? The next decision is whether do you do futures, cash, options, etc.? What's the best strategy? I like to use options for flexibility in row crops or producers for protecting price direction when I feel uncertain about either seasonals, profitability at that price level, fundamentals, or just even percent covered. For example, if I've already sold 80% of my crop, I don't know if I should sell much more, but I really like the price where it's at. That's where I'd maybe lean towards like buying a put option, for example, or leaning more into options. This picture can help identify the heart of your needs, I think. How aggressive of a strategy do you need for your financial situation or risk tolerance? Once you kind of decide that, that'll help tailor what opportunity is best for your business. And this graphic, I think, illustrates how intrusive strategies can be. On the left is going to be the most bearish thing you can do, and on the right is going to be the most bullish thing you can do. Let's think of it this way. If a corn a corn producer perspective. If I'm growing corn for this next year, selling cash is nearly the most bearish thing I can do. On the right side of that spectrum, doing nothing is the most bullish thing I can do. Options, no matter what strategy you kind of do one-to-one, that's going to be somewhere in the middle of that. So you can see on the far left, most bearish thing is selling cash. The next most bearish thing I could do is sell futures right alongside of that, basically. Next, right alongside of that is like buying a put, selling a call, a collar strategy. And then to the right of that is buying a put, and then doing nothing's all the way to the right of that. So those are just a few ways of, if I'm bullish, but I need to kind of protect price, maybe you float kind of somewhere in the middle using options here, where if you're like, I'm super bearish, I need to protect corn at these prices, it's profitable, it's right time of the year, all the boxes seem to be checking, then maybe you're just selling cash or selling futures, something along those lines. So let's talk about some examples, because the best way to understand options, in my opinion, is to just work through scenarios of how they work. So when I look at the first one, which I'm going to start on the buy side, make it a little bit simpler. Let's talk about buying a put, and I'm going to be talking about 3 scenarios. On the left is a profitability scenario. The middle one is going to be a break-even scenario on this put, and then buying something on the right is going to be a max loss scenario, for example. So let's talk about one. Futures price today is at $4.80 on a December corn futures, for example. And we're going to look at a strike price at the money. So the premium is going to be 30 cents today, and we're buying a put, so we're going to be spending 30 cents on that put. So that cost is going to be directly $1,500. That's exactly what you'd be putting in to buy it. And then break even is going to be $4.50. So let's look at a profitability scenario. So if corn falls on December at expiration to $4, put value at expiration, your right is to be short or sold at $4.80. Your futures price now is $4. So that means you are 80 cents lower than where your strike price is at expiration. Less premium paid would give you 80 cents as your move, minus the 30 you spent on it, is going to be 50 cents of profit. That's going to be a net gain of $2,500 above and beyond your $1,500. When I look at the break-even scenario on corn, let's say we fall to $4.50. So your put kicks in. You have the right to be sold at $4.80 if you want it, and we're at $4.50. So you're below the price of your put. So you'll want to take it or exercise it. So that's the 30 cents per bushel loss from where you started at on your strike price. So the less premium paid, you paid 30 cents and the market went down 30 cents. That's a break-even scenario. No gain, no loss. Now let's look at the right side, a max loss scenario. Let's say corn goes up to $5.20 or any price above it, for example. Your put expires worthless. You are above $4.80. And this is very simple. If I gave you the scenario, that price is now at $5.20 today, and I told you you have to sell corn, would you rather sell it at $4.80 or would you rather sell it at $5.20? You're going to say, well, $5.20 is higher than $4.80, so I'm going to let that put expire worthless. It's the right, but not the obligation. That's the key, and that's the difference between futures and options in the big sense of things. So the premium you lost was 30 cents a bushel. You paid that net. That was $1,500 per contract, or 30 cents a bushel that you will lose. In a row crop example, remember, this is a good thing because now you bought a put and it's worthless, but the price of corn is now $5.20. Before, if you would have just sold it that day at $4.80, you would have had a lower amount. So this is kind of the key in watching this. It's a So key takeaway, maximum risk is limited only to the 30 cents per bushel premium paid. There's no margin calls with buying puts, just that initial premium that you've got to pay for up front. And then you keep upside potential if the cash price keeps rising for the commodity that you're trying to protect. Let's talk about a call. So same scenario, a $4.80 futures. So your strike is at $4.80. You're going to be spending 30 cents a bushel on this one as well. Your cost is $1,500 a contract, and your break even is going to be $5.10. A very simple way of looking at this is if you're at the money a lot of the time, your put and call should be very similarly priced. Sometimes it'll be one side will be worth more than the other, but normally it's very close to each other on price. But let's look at the profitability scenario. If corn goes up to $5.60, so You have the right to be owned or long at 480, and the price is at 560. So you're going to want it. So 560 minus 480 is 80 cents. You paid 30 cents for it. So your profitability is 50 cents per bushel, $2,500 per contract. In a break-even scenario, corn goes up to 510 at expiration. 510 minus 480 is 30 cents. You paid 30 cents for it. You had 30 cents gain above your strike. That's a break-even scenario. Now, if you would have only paid, let's say, 15 cents for that call instead of the 30 cents you paid up front, then you would have made 15 cents per bushel, for example. Let's talk about the max loss scenario, which is easier on buying an option, right? Corn falls to 440 or any price below it. You're below 480, so you don't want to be long or owned at 480. So it's worthless. It's 0 cents. So you paid 30 cents for it. Now it's worth 0. So your max loss is at 1,500 that you spent. Key takeaway, maximum risk is limited to the 30 cents per bushel premium paid. No margin calls, just the upfront fee. You benefit from rising prices while you've already sold your physical grain, for example, in one scenario. Let's talk about the sell side. This can be very interesting. So if futures are at 480 and your strike price is 480, we're going to sell a put and collect 30 cents per bushel on that put. Your income or gathering is $1,500 per contract. So let's look at this. So if corn rises to 520, this is a max profitability scenario, your put expires worthless because you gave the right to somebody else to be sold at 480 and price is at 520. They won't want it. And that's going to be worthless then. So it's 0. So you collected 30 cents, which is your maximum gain on these because you sold it. You collected a premium up front. That's the most you're going to gain, 30 cents, $1,500 per contract. On a break-even scenario, so you sold your put at 480. The price falls to 450 on break-even. That's a 30-cent move. You collected 30 cents for it. It's a 30-cent move to the downside. It's a net gain of 0. It's a break-even. Any price below that 450, you would have started to lose money. Now, let's talk about a loss scenario like we just mentioned. So if the price is at $4 now, you gave the right to someone else to be sold at 480. The price falls to $4, so that's an 80-cent difference. That difference would be 50 cents between the premium you collected at 30 cents, the move of 80. That's 50 cents of a loss. So that'd be $2,500 per contract. Now, with selling a put, this is a lot different because buying a put, the max you're going to lose is whatever you paid for the premium. With selling it, the max you're going to gain is whatever you sold it for. But the max you can lose on the scenario is infinite. If corn went all the way down to a negative number, for example, like crude oil proved it could do a few years ago, you could continue to lose on the way down. So that there's no maximum loss scenario with selling options. Let's talk about a call. 480 price again. You've got a strike call at 480. Your premium you collected was 30 cents. Your income's 1,500, and your break even's 510. So let's talk about max profit scenario. Corn falls to 440. Your call expires worthless. You gave the right to someone else to be bought or long at 480, but we're at 440 now, so they don't want it. So you gained 30 cents on your sold call. Easy enough. That's your max profit. Break-even scenario. Let's say you sell the 480 call. You give the right to someone else to be long at 480. If corn goes up to 510, they're going to want to be long at 480. You sold it for 30 cents a bushel. The move was 30 cents a bushel, so the net gain is 0 by the end of it. Corn rises to 560, so any price above that 510, you're going to be losing on that scenario. So if you look at the 560 minus a 480, you gave the right to someone else to be bought or long at 480. That's 80 cents a bushel that they'll want. Obligation minus premium is going to be 50 cents a bushel loss. That contract net loss is 50 cents. Now, if that keeps going up, you can have maximum potential losses on the way up. There's no unlimited, there's no limited amount of risk or money you could lose on this. So you got to be very, very careful with selling options, both calls and puts alike. Now let's look at something a little bit more detailed, something that we'd be doing on row crop industry, for example, to protect price. So if futures are 480 and you go down and you say you want to buy a 470 put, so you want the right to be sold at 470, but not the obligation. You're paying 25 cents a bushel for that 470 put. So it's kind of expensive. You're like, by the time that would go down, I'm not going to get paid until 445. That's kind of a long drop before I start to protect price. So I'm going to want to sell a call against it to help maybe limit my top side, but help pay for my put a little bit. So I'm going to sell a call for 15 cents at 520. That net cost is going to be 10 cents a bushel or 500 contracts net at the end of the day. Now, this is a very realistic strategy, very realistic net price that you'd be collecting in this environment. So if you're at 480, this will be a strategy you could likely do if that scenario is occurring. Let's talk about a profitability scenario on it. Corn falls to $4. You paid the move is 70 cents that you collect profit. You paid 10 cents net for the position, so you made 60 cents. So your futures floor was 460. You're at $4. You get $4 or 60 cents for the move profitability wise. Corn stays at 480. That would help show that both sides are going to expire worthless. You don't want the right to be sold at 470, and you didn't give the right to anybody else to be long at 520. So it's going to be worthless on both sides. You spent 10 cents, so you lose that 10 cents. That's all you lose. But you're selling your corn at that 480 level. So in this example, anywhere between that 470 to 520 is basically going to be a wash scenario or expire both sides of the strategy. Now, your capped upside scenario, which would be a max loss scenario, would be a call obligation kicks in. So let's talk about if we go to 560. You sold that call at 520. So you have a 40-cent loss on the call that you sold. The put you bought is going to be worthless because you don't want to be sold at 470. Price is higher than that. So your max ceiling price is going to be 510 a bushel because the price is at 560. You lost 50 cents a bushel because you lost 40 cents on the strategy and you paid 10 to do it. So 10 plus 40 is 50. So now your ceiling price is 510. So that strategy is very nice because if I own corn that I'm going to sell or produce, I'm willing to say, I want to protect today's price, and if it goes up to a certain level, that's okay. If it goes up above that, I'll be happy if I get maxed out at that. So this is a very realistic strategy that I think farmers entail today that we work with and can be very, very used. So this is our closing. This is the option series that we've worked through today. Thank you for joining on. If you have any questions or concerns or want to know even more about option strategies and how they can work for you, please reach out to us. We would love to work with you. And thank you for the opportunity in watching our video today.